The 2008 financial crisis erased $13 trillion in American household wealth, or at least that is what the headlines claimed. People watched their retirement accounts and home equity vanish in real time as market tickers collapsed. But that money did not actually evaporate. Financial crises do not destroy wealth, they transfer it. Capital moves from those holding the wrong assets to those who position themselves correctly before the storm arrived. In normal times, paper assets like stocks, bonds, and cash function smoothly. They are essentially claims, promises on future corporate earnings or government debt repayment. But when a systemic shock hits, the value of those promises deteriorates. The paper claims rapidly lose their purchasing power. While the majority panic and sell, a prepared group does the opposite, using their liquidity to acquire solid, tangible assets at severely distressed prices. Historically, when paper claims fail, capital safely moves toward the few assets that cannot be printed or canceled. Recognizing the specific pressures that drive this migration is the first step toward positioning your capital where it can be preserved. The first pressure point is debt. The United States government currently carries a national debt of roughly $36 trillion. The interest payments alone now cost more than the entire defense budget. Meanwhile, American households hold another $18 trillion in consumer debt. High debt loads do not cause crashes on their own, but they eliminate the system's margin for error. They create a rigid environment where a single, localized shock easily cascades through the entire economy. Add to that the second pressure point, extreme market valuations. Right now, United States equities are trading at multiples rarely seen in modern history. This chart tracks the cyclically adjusted price-to-earnings ratio, or CAPE. It measures market valuation by smoothing out short-term earnings to show a reliable baseline. The data shows that the current margin of safety for equity investors sits at historic highs, levels exceeded only in the months immediately preceding the dot-com crash of 2000. You have record leverage combined with ultra-thin margins of safety. This creates a hyper-fragile structure, entirely exposed to any sudden external shock. That external shock could easily come from the third catalyst, geopolitical instability. The BRICS nations are actively constructing an alternative financial infrastructure designed explicitly to bypass the US dollar. At the same time, the ongoing Russia-Ukraine conflict and escalating tensions in the Middle East present active threats to global energy distribution and supply chains. The final catalyst is the artificial intelligence investment cycle. The largest technology companies are currently committing roughly $300 to $500 billion annually to build out massive physical AI infrastructure. Markets are pricing in rapid, large-scale returns on this infrastructure. If those returns lag behind the massive spending, the system faces a pullback in tech capital expenditure, a structural setup similar to the period leading up to the 2000 dot-com bust. Unmanageable debt, stretched valuations, geopolitical fractures, and an AI hypercycle. Combined, these four forces exert a massive gravitational pull. When they trigger, they will aggressively strip wealth away from traditional exposed portfolios. To protect your capital from those forces, you have to position it into specific catch basins before the ignition sequence starts. You need assets proven to absorb migrating wealth during systemic stress. The first catch basin is gold. It is a strictly monetary haven that maintains purchasing power precisely because no government can print it, digitize it, or debase it through central bank policy. Right now, global central banks are buying gold at the fastest rate since the 1960s. Following the freezing of Russian sovereign reserves, nations worldwide learned a strict lesson. Physical gold held domestically cannot be sanctioned or seized remotely. The second category is real assets, specifically productive agricultural land. Farmland operates on pure intrinsic logic. A farm in Iowa does not react to Federal Reserve interest rate hikes. It produces food. Because human beings always need to eat, the demand for agricultural products remains inelastic regardless of how badly the stock market crashes. These physical assets survive because they generate actual utility from the material world, instead of relying on the fragile promises of a leveraged financial system. The third asset is Bitcoin. It serves as a highly portable digital haven with an unchangeable hard cap of exactly 21 million coins, offering an uncensorable hedge against government currency debasement. The asset is no longer exclusively held by retail speculators. The approval of spot ETFs has brought Bitcoin into the same regulated accounts that manage trillions in retirement and institutional capital, creating a long-term holder base that didn't exist 3 years ago. This chart breaks down a practical portfolio framework. Serious wealth managers suggest maintaining your core diversified equities, but carving out a specific crisis protection allocation of 15 to 25% of your total investable assets. Inside that specific allocation, gold takes the largest share at 8 to 12. Bitcoin takes the smallest sliver at 1 to 5%, enough to capture the upside of currency debasement without exposing your entire portfolio to severe volatility. The biggest mistake investors make is waiting for the evening news to declare a crisis before buying these assets. By the time the panic is official, the protective assets have already spiked in price. You cannot predict the exact day the system breaks, but your positioning is entirely within your control. You must secure these assets before you need them, because buying them during a panic will always cost you a premium you cannot afford.